Hi, everyone. Welcome to our second episode of Reinventing Finance podcast, together with my co-hosts Tom and Simon, our second guest. Simon, do you briefly want to introduce yourselves, please?
Yes, well, thank you for having me, Nicholas. So my name is Simon Torrance. I'm an independent advisor to boards and leadership teams on business model transformation, fundamentally improving their economics as digitisation affects them. And I'm currently focusing a lot on the topic of embedded finance and embedded insurance, which I feel is a very, very hot and important topic.
Absolutely. So why don't we kind of dive right in? Embedded finance slash insurance. How would you define that topic? What's the, why does it matter? What's the story behind that?
Yeah, well, let's look at the problem that it's trying to address. Well, let me start by explaining what it is, then I'll describe the problem, put it that way, maybe a better way around. But essentially, it's about taking financial capabilities, abstracting them into technology, and enabling, in so doing, any organization, any developer within an organization, a product manager or an engineering team, to embed those financial service capabilities into their propositions really easily. And the simplest example of this is Uber. When you get into an Uber car, someone has sorted out in the background the whole process of payments. You don't have to get your card out at the end and pay for it. And that's part of creating a really great experience for me as a rider. Uber also has embedded insurance and banking services into their service for drivers as well. So if you're an Uber driver, you get insurance is paid for and sorted out by them. So that essentially now, with modern technology, it's really easy to take all kinds of different banking or insurance capabilities and products and embed them at the point where the customer is most interested to buy them. And for those organizations that have those customer relationships, which are creating those experiences, making it really easy for them to do it, rather than what happens today is that to get a loan or to get insurance, I have to call up the bank or go to the insurance company. Increasingly, I'm able to access the type of financial service at the moment when I really need it and when I'm ready to buy it or consume it. So that's what it is. And why I think it's so important is really for two reasons. And the first is a societal reason, and the second is a commercial reason. And if we start with the societal reason, what we can see is there is an enormous gap between what people need from financial services and what's being offered and how people can get what they need. And if we just take insurance as an example, there are so many people that are underinsured, in some countries underbanked, and many people can't get a loan, or it's very, very expensive to get a loan if you are of a certain income bracket. And of course, there's huge need to be protected with insurance, to do savings, to get loans, even to have a bank account in some countries. But the system as it currently stands is full of friction. The supply side of the equation is not matching the demand side. And so what embedded finance and insurance does, it helps those organizations which are closest to customer demand. It gives them the ability to create very personalized, relevant, and affordable solutions for those customers in ways that are quite complicated for the existing supply chain to provide them. So that's, if you like, societal opportunity to close that protection gap. And even just in savings for retirement alone, just take that one example. The World Economic Forum suggested there is an $11 trillion gap between what people need to retire comfortably and what they have today. And even where I live in UK, savings is people just don't have enough money to retire or even to save for things in general. So that's societal benefit and, if you like, consumer benefit. Commercially, why it's attractive to insurers and banks is that they have enormous costs of distribution. So insurance, I think something like 50% of the total cost of their operation goes in distribution. Well, now if someone else is distributing the product much more effectively to customers, that reduces their costs dramatically and could improve their economics significantly. So that's my sort of, if you like, shortish introduction to the opportunity: societal benefits and commercial benefits.
If I and Tom, please add. But if I may, I think on the I thought the Uber example was quite interesting that you've mentioned it, because initially I thought, well, it's just a payment service provider, right? You know, that's you know, okay, what's the big deal, right? We've done that. But I think knowing, for example, another very successful taxi app, for example, in Europe is My Taxi, right? Or they're now, you know, kind of, there's lots of, I think, Share Now, they've now aggregated the big OEMs. But I think the interesting thing actually was within an Uber app, you can just walk out, right? And that means irrespective of your connection, Uber is effectively, for very short-term underwriting, your risk of non-payment. My Taxi doesn't do that. So they're actually, by just flipping this small effect around, you don't have to sit there and have a proper credit card, etc. Uber is bridging that gap. And to me, that was actually, so I thought that was a very elegant example on how that makes it a lot easier, because, for example, it actually allows you to be abroad, get the Uber on your Wi-Fi, and not have roaming and still use Uber, rather than having an excessive roaming contract. So I thought that was actually something really close to heart. Thanks for using that example.
May I ask, just to understand embedded finance with the old world, let's say in the past you also had a kind of, but it would be the question, is this also embedded finance if you talk about, for instance, credit cards in the past, or consumer finance, or car banking, or you buy a car and then if you saw the profits of the car manufacturers, they earned an enormous amount by financing the sales of their cars. Would you also call this embedded finance, or is this very much connected for you to this new modern type of digitalized way of embedding it in the IT infrastructure?
Yes, it's exactly that, because you know, you can, if you want to buy, if you buy an airline ticket, they offer you the option to do, you know, to get some insurance, don't they, say at the point of purchase. So that exists today. And as you say, car companies sell insurance and loans and things like that. The point is that digitization is allowing the financial service to be embedded in nearly any situation really easily. And all those, so, you know, if I buy a BMW car and I use BMW Finance, I have to call up BMW Finance, or it's a separate process. It's a parallel process. But with digital technologies, it can all be seamlessly integrated by the product managers who are designing the experiences, like the Uber example, to make the experience so easy. And then the financial service aspect can just be sewn in. So another good example actually is Shopify, a very successful B2B e-commerce company. And because they have you know, millions of merchants now on their platform, using their platform to market themselves, they're in a brilliant position to say, well, why don't you use our payments service, which they offer? Why don't you take a loan out from us when you need it? Why don't you buy insurance from us? And they make about 50+% of their revenues from what they call merchant services, and I would call embedded finance. So commercially, it's really attractive, because there are now, you know, the technology has been worked out to make it really easy for Shopify to become essentially a financial services provider really seamlessly without having to set up complicated new operations, which are very manual and analog. So I'll give you one other quick example as well from in retail. Retailers have been selling insurance and loans for a long time. A lot of retailers have their own bank,
Yeah.
but it's never been very successful because banks are not very profitable as businesses. And in fact, if you look at on average insurance companies, on average they make negative economic profit these days for all kinds of reasons. But the retailers will have offered pet insurance and home insurance and all kinds of good things like that. But it's never been profitable because they have to do very complex deals with third-party providers, all offline, analog, taking years to negotiate and very difficult to integrate. And what embedded finance does, it just essentially leverages advances in technology to make it really fast and easy to embed a financial service offer at the point of need for virtually no cost to do that, whereas in the past the integration operations costs were very significant. So if you're running a retail business, you want to test ideas or offers to your customers. You can now do in weeks, whereas it would have taken years to do so in the past. So you're right, technology has enabled if you like a form of distribution that existed before but can now be done on steroids. And what's really interesting for me, I did some analysis on the market size for this. And if you look at current trends, how payments are being embedded, loans are being embedded, insurance just starting as well, and you look at current trends and you project them forward, it looks like this could be, fintech is creating a new market worth about $7 trillion for companies that enable what I've just described. And what we're talking about is in fully digitally embedded financial services, taking a larger share of the distribution market. So we're not talking about increasing the size of the market. We're just saying that pure digital automated embedded services will take in payments probably about 40%, in insurance about 20% in 10 years time, in lending 25% in 10 years time. And you do the maths and you add it up and it gets to a very, very significant number. So, organization, that's why VCs are pumping a lot of money into what they call fintech infrastructure. Yeah. But bank as a service, you're seeing a lot of investment there. Insurance as a service or embedded insurance companies now increasingly, and lending at point of need. So, if you're an entrepreneur, if you're a VC, this is a very hot area for the reasons I mentioned. There's huge demand and there's big friction. And then if you're in an incumbent, whether you're a bank or an insurance company, you've got to very quickly work out where to play in this market. Otherwise you could be commoditized and just become the supplier into someone else's, very powerful system.
You touched on so many interesting points there. I just wanted to, because I thought the question is from Tom is kind of, what's the difference, right? I've been selling life insurance to my bank assurance partnership, and now you come around and it's about embedded insurance, but we've already done it. But I think that the key point around it is that it is productized, right? And if you're currently looking at why does it take so long? Why does Zurich and Deutsche Bank need another 10-year marriage? They needed to protect the levels of integration currently at play to making this work, right? To protect each other's investments. Now, the question, if you're putting it on a modular APIs driven platform, if you're taking it as a digital product, like Stripe would provide or other payment service providers, it removes these barriers of integration. If you have a digital substrate, the operations cost. So I think technology takes a really big play in this. And I think that insurance companies, which is more of an area that I'm familiar with, can actually provide more and better services by alleviating the requirement of large distributors to rework large parts of the value chain, which they currently kind of have to do, right?
Yeah, I was going to say the other piece that's really important is that, again, because of digital technology allows this, you can combine the customer data of the, let's call them the embedder, the organization which is embedding financial services. Say it's could be a telco, could be a retailer, could be a, maybe it could be a trade body that has lots of professional members. But they have a lot of data on their customers. And of course, to make underwriting more successful or lending less risky, the more data you have, the better. So rather than underwriters sort of guessing the risk of giving a loan or insuring a certain customer because of his age and where he lives or whatever, we can combine the data from the embedding organization with the insurance company or the lending company to create much more tailored, personalized, and affordable solutions. So I think that's the other thing that's really important now. So we have the ability to combine that data. And a great example I heard recently, where this is from in Mexico, actually, where there's an enormous protection gap. People, and very, very underbanked. But the company that was creating a new lending as a service platform was collaborating with the biggest telco, and the telco, because they have all this location and payment, they have payment data about how creditworthy people are because how well they pay for things. They were providing 140 new data points for the analysts at the lending company to put into their system. So if you've got 140 new data points, it allows you to do much more create more clever algorithms to create more personalized and hopefully affordable lending. So that helps everybody. It helps the consumer, I can get lending, cheaper lending, helps the lender, I can get more people to buy up my stuff. And it helps in this case, the telco, because they're adding value to their customers. So that's the other important thing, the mixing of the data. And I would say, particularly now in Europe, where we are, open banking data is now unleashing, as you probably know extremely well, enabling us to do much more targeted, and again, a new source of data to help us do more targeted and affordable financial services as well. So again, rather than using credit scores, which are never really very accurate, we can actually see, payroll, exactly what people spend their money on, and do much better underwriting as a result.
And I think it's really interesting. I love the example, the Mexican telco lending example, because what a lot of, I would say, business people, at least in insurance, when they hear an API, or web service is what they call, they think standardization. It's the same thing for everyone, because that's kind of what they've learned. That's what but it's not. It's a API driven infrastructure, but the quotation is very much tailored per partnership, and the technology needs to do that, because of course you're going to take those 140 data points. And what it also means is not everyone might already, you might not have all the signals yet, because at least insurance is actuarial driven and it's not data science driven most of the time. So another key element to play, or if you disagree, please do let me know, would be to even be able to collect, structure, then analyze, and then re-inject. But I think it's what insurance companies have learned is that they have all these great risk models, but you cannot ask these questions. So you need to dumb it down so it is affordable to be questioned, in a advice-driven sale, because I cannot ask 180 questions to get a home insurance policy. But now this is being flipped back on around. It's actually the time of the actuary again. You have all these risk data points, but that I would say is one key element to win, to also have this in your mind, that you want to capture this data and not be scared of it, which currently seems to be the case. I just had kind of coming back to the original two reasons, societal and commercial. And when you say the protection gap, right? So let's assume that there is an underwritable risk, right? Because if it's not everything is insurable. It's also what we've kind of learned from the pandemic. It's not insurable. Not everything is. But let's say that for those that are actually insurable, would you say the societal reason for the protection gap is because by leveraging existing customer touch points that exist, you'll reduce at least the fixed investments to get to the customer? Whether someone charges a rent on their railway is a different thing, right? And secondarily, that because you do have, let's say, contextually relevant data points, you can then start to underwrite. Are these the kind of main forces of how to close the protection gap, or is something missing there? Because I think that there is a step in between to kind of say, I'm offering, I don't know, a payment solution somewhere, and this is how we're going to fix people's retirement.
Yeah, so the gap seems to me to be related to, one is awareness and interest at one level. Okay. So no millennial wants to get life insurance because they're going to live forever in their mind, and they're not going to get any health insurance because they never get sick, and they're not going to save any money because they're going to become millionaires, so they don't need to save any money. So there is this there is a certain level of education and understanding and awareness that is part of the gap. And the other thing is that even if your parents sat you down and made you aware and made you concentrate on this, or it's just terribly dull and boring. Buying life insurance, you buy and then you die, and there's no interaction in between. So and this is, and for if you live in the West, and if you're rich and live in the West, then yeah, it's okay. You'll probably earn good money and you'll sort it out when you're a bit more mature. But there's plenty of really underbanked people in my country and your country, and people who just don't save money because they don't have much money. But there are now lots of businesses that are helping people to, if you like, do the right things for themselves by putting the activity in the background, and making saving or insurance an ingredient in their everyday life interactions. And I'll give you a good example of this. Actually, from Singapore is another good example, but I use these external examples because they completely apply here, by the way. But an insurance company has now created a fuller set of financial services and embedded them in the everyday services of their consumers. So when you go and when you go to the gym and pay for things in a gym, automatically part of that payment is going into a savings account, and part of it can go into a health insurance top-up service. And every time you go on the metro, some of that money is put into a savings account as well. So what they're trying to do is to make it, because people go about their daily lives, but if we can, if you like, embed putting money aside or for savings, or putting some money in investments, or every time you go to the gym, you get some credits towards a health insurance or a life insurance. All these things add up over time, and you're making it, you're enabling people to get the protection that they need without talking about financial services, which is terribly boring for most people. So that's another aspect of embedded financial services. It goes into the everyday activities of people. And so in the UK, there's one business I'm working with at the moment, which has created using open banking data, a way for people to get cashback offers, which has been around for years, from merchants when they buy things from the merchant. And the open banking data enables the merchant to make more targeted offers. But, and this is the interesting thing, so cashback is good, people like cashback. But the interesting thing is that the money, the cashback, goes into an automated savings account for them.
Yeah.
So the service is called upside savings. And so it's about, you get an upside, it's going into savings. And it's a different way, it's a psychological way, a different psychological way of engaging with people. You're going to buy things, you know, as you go throughout your daily life. Why don't we make it really easy for you in a way that you can understand and change and as you wish, but we'll just make it easy for you to put that money aside. And I think that's part of closing this, that's part of closing the gap. I'll just continue, I'll just finish my train of thought and then we'll let you sort of come back on this. But so at least we're making it easier for people to do things that in the past were too boring to do. The other thing, of course, is it needs to be affordable. Particularly insurance needs to be affordable. And if there's just, at the moment, we're not getting that right. And again, if we can combine real-time, real data with the underwriting capabilities of insurers, then we can start to create products that are much more affordable because the risk of claims are much lower as well.
Just to ask a critical question, if I just see, let's say, the amount of examples you see at the moment in embedded finance, it's mainly about boosting consumption. So it's about consumer finance, companies like Firm, etc. So we'll tell, and also if you take statistics, younger people, in comparison to let's say 20 years ago, are let's say consuming much more on credit, especially if you take telco companies, etc. And this whole combination. So I'm just wondering, let's say I especially see a lot of examples with on the credit side, consumer credit, etc. I don't see that many examples on the positive side, or it has to be, let's say, African farmers or Chinese farmers who were able to get insurance and they were underserved in the past. But if I just take the West or I take Europe or the US, I just see the opposite. So I see from a societal point of view, more negative aspects of this embedded finance. And the question would be, do you see it as well? And what would be the role of regulation? My personal opinion is that regulation should speed up their responsibility, so to say.
Yeah, well, that's a very, very good point. So the big buzzword at the moment is financial wellness. So financial wellness is about savings and being protected and reducing the stress from finance. That's one of the biggest stresses on people is, do they have enough money to live their lives? If they do get injured, can they carry on working? So what I'm seeing at the moment is a lot of people trying to help people with financial wellness. And you get a lot of sort of, you're now starting to see a lot of clever budgeting tools. I mean, the example I gave before about automated saving is a really good thing because it's not encouraging you to buy any more. It's just saying when you buy your daily goods, you're now getting cash back, which is very relevant to you and the merchant, because data in the past didn't really connect the offers with the person very well. There's a lot of friction and waste in that activity. And the money is being put aside into savings. So that's actually a very positive example of helping people do something which they find difficult to do. So you're quite right. We need to be, now, obviously, it's good for people to be able to afford to buy things when in the past they couldn't, but just encouraging rampant consumerism and getting more debt is not very helpful. So I think the companies that will win are those that help people manage their financial wellness better than others. And that will be enabling you to save up for something which is really important, enable you to get the right type of insurance cover that is actually relevant to you. Not a terror. I mean, I tried to get some, I'm in the UK, I get free healthcare in theory, but I tried to get some top-up healthcare insurance. And it was, if I make any claim, the money is, they make the money back on the increased premiums. It's just not a good system at all. It doesn't help me, so I don't do it anymore. So I think you're exactly right. There is those companies that are helping financial wellness will be the ones that will win. The role of government and regulation, I think, is interesting. And PSD2 has actually been a huge boon, a huge enabler of innovation in this space, because that data that was locked away by the banks, they never used it at all in the way that they're now forced, or it's now being forced to be used. That data enables me to have a different type of credit score, to get a cheaper loan, to enable me to pay for my children's whatever I need to pay for my children. And that has been locked away before. So that's a really good example of regulation which is helping to make financial wellness, or enabling that to be better. Of course, regulation on payday loans and all the bad behavior in lending is really, really important to protect us as well. But I think there is there's a bigger discussion now about private and public collaboration to close the protection gap, because most of the protection gap is actually from, related to public retirement benefits, that the public purse cannot afford for everybody to live to 120 years. So the government has a really big challenge, but also the private sector to innovate to enable financial wellness. I think that's the big hot opportunity for us all.
I think it's interesting, and I think there could be an argument to be made that from a technology point of view and a business point of view, at least enabling certain transactions at a much lower cost, and then also letting the consumer kind of decide, while still having a parallel social discussion about what's right and how much credit we should have. I think I think regulation needs to step in on that. I don't think the incentives for kind of profit-seeking enterprises are structured for that. But I think it's also okay. I mean, that's just how that works.
Yeah, let me share another example. While I'm just thinking about it, I'm working with a company that provides a platform for renters. Mm-hmm. So in the obviously there's a large proportion of the population of people that rent properties, and in London, at least where I live, something like 50% of your income is taken up by rent if you're a renter. So 50% goes on rent. You're suddenly 50% poorer because you rent a place. And that's a really good example of this company. It's there to help people find places to stay and look after them during their rental life. That's their mission. And they support landlords as well, and they support renters, but making your rental life better. And they've recognized that just finding, a nice place to stay is only part of their proposition that is valuable. Helping people to manage their payments so they don't fall in arrears or fall behind with that is important. Helping them with getting affordable insurance and relevant insurance is also part of their role. Helping them to get other financial services to pay for goods for their houses is really important. But also they start to look beyond that at other things that renters need in terms of being able to access services, cleaning services, food delivery services, help them find jobs. And because their mission is to help that audience of renters to live a better life, they're in a much better position to define what creative financial services could suit those people than the banks or the insurance companies that are 3 steps away from those individuals. So I think that's another good example where there are, again, in that case, it's a private sector business which is helping its audience. But there's lots of social housing, of course, across Europe and the rest of the world as well, run by the government. We could apply the same principle there as well. At the moment, those people who provide social housing don't do that. Making a blunt statement, they collect the rent and they make sure that the house isn't falling down and is up to minimum standard. But they're not doing much more, as I can see it, beyond that, and certainly not much more in terms of financial wellness, which is one of the biggest stresses on people's lives.
Thank you. Yeah. I wanted to come back to the commercial reason that you stated at the beginning, and and you've stated 50% of is currently spent on distribution. Now, it's different per product line. I think in P&C I'd say probably 20% on average, but still a large chunk. And there's certainly, and I think the UK can be a testament, there's been some mis-selling around PPI and things like that, where you had exuberant commission schemes, right? On embedded. Actually, these were very embedded, funny enough. My question is just from a kind of structural perspective. In your opinion, do you think that partnering up with a large, powerful digital distributor, Amazon, Apple, big bank, that from an insurer perspective, it will actually drive down the costs of distribution? Or won't the distributor, as you could see, let's say in travel, now just recuperate larger and larger chunks of that if they wanted to? I mean, they could also pass it on as lower costs, but do you really see for an insurer that they will lower the percentage points of distribution in a ecosystem aggregated world? Or won't it just be harder because they have to deal with much more powerful distributors than their, let's say, long tail scattered agents or brokers?
Yeah, absolutely. This is changing the economics of the industry. So the incumbents need to rethink how they operate. So currently, as you say, that there's a big bit of friction in distribution and sales, massive friction in sales. There's also friction in terms of, as I said, connecting what people really need with what you can provide. And that's because a lot of it is blind. You don't have enough data on the whole market to be able to underwrite effectively. So there's a lot of friction in this market. And if you look at, and I said, on average, the insurance industry, if you look at the top 200 companies and you aggregate their economic profit, it's negative, and it's due to get worse because of digitization is creating these new power changes and in the market. So something's got to change. So that you're exactly right. You carry on doing what you're currently doing, then the economic profit profiles are going to get worse and worse. So it means you need to rethink your strategy, rethink how you distribute, rethink how you create products, how you access data, and merge it across silos, as you say. I mean, I was speaking to one very big insurer yesterday who said, once the Apple Watch now, I believe, can measure your glucose levels. So they've made some advances in it. It can now measure very accurately glucose levels. Once it does that, it can help people with diabetes in ways that weren't possible before. So it becomes like the dongle in your car, the telematic dongle in the car. You now know how people are driving. You now know when people need, when they're going to have diabetic problems. That changes the nature of healthcare and insurance for diabetic people, just as telematics is changing the whole notion of insurance for cars. So all these technical changes, these in terms of how society is changing, people living longer lives, digitization, which is fragmenting the traditional tech stacks of banking and insurance and making all the elements modularized and able to be embedded into technology. That's changing the fundamental economics of the banking and the insurance industry. So the answer is, it's not just a question of, well, will Amazon, control everything and reduce your prices and you'll be commoditized? Yes, probably. That's what tends to happen. You need a completely different strategy now. You need to know where to play and how to win, and you need a different way of innovating as well. You cannot innovate, let's say, do disruptive or breakthrough innovation from within the core business. That is set up to operate the existing business model, which we know is under increasing pressure. You need to defend and reinforce and protect that and automate and make it much more efficient. But separately, you need to create a different space in the organization, a separate space where you can do breakthrough innovation, working out how to create your own digital platforms rather than just being a supplier to someone else's, working out how to create your own financial wellness apps or capability or in components for other people's apps, working out what types of how to really embed your products very quickly in other people's businesses. You need a separate space for that. So what I am really saying a lot at the moment is your current structure will prevent you from being successful in this world unless you create a more ambidextrous one, protecting the core, fast tracking the future. And without that, it's going to be much more difficult to thrive as well as survive. So I think what I'm saying is that we need a clearer understanding of the future, a shared vision of what it's going to be like, because often, as you say, leaders of incumbent banks and insurance companies are not technologists, and they find these things, let's leave it to the IT department. Their business is now technical. They are running technical businesses. They need to be technically minded or hire people who are. A clear vision of the future, and then a different structure in which to take advantage of it. One which does defend and optimize and protect the core, transform it. It's going to take time, but fast track the future. If you can get that structure right, then you can, with that vision, then you're in a good position. At the moment, I don't see that very much in either the banking industry or the insurance industry, but the pressure is getting stronger. I think we'll start to see some fundamental structural changes coming up quite soon as a result.
So we're kind of running against the time of our podcast, and I know you have we all have a hard cut, but I try to, because I think this is really key, and I fear that if we left it here, people would go, of course, Simon, but this is not my reality, right? I have all of these different priorities to fix, and yeah, okay, So let's maybe try to rephrase this question. Let's say under which conditions, right, would you even take either, the board member, CEO, or whatever, person responsible for this new venture unit, under which conditions would you even say, okay, if these conditions are met, I'd give this a go? And what would maybe your first 100, 200 days look like? And let's assume, let's not take, the biggest guys who have just money to waste, as it seems. Could you maybe just run us through your thoughts on that?
Yes, a very good question. So I think this first step is understanding, because if we don't even understand what embedded finance or embedded insurance is, or we think it's something for the IT department, there's no chance of anything happening. If we are to believe that 20% of insurance could be distributed through digital embedding, which is what my projections suggest, that's an enormous part of the market, and that's worth $3 trillion in terms of market value for those who can enable it. So step one is to properly understand it yourself if you are a leader, even if you're in a mid-sized company. Because once you understand it, at least, then you can create the right strategy to respond. And you can create a strategy that suits your ambition and your capabilities. And there are many different strategies. You don't, from very bold to focusing on just protecting what we do or being expert in our niche area, maybe divest things that we're not so strong on. But I would say that's the key thing, that fundamental proper understanding. And then in terms of this structuring I've talked about, it doesn't have to be some complex restructuring. It's really setting up a separate group with power and prestige to act like a startup company, or a VC creating a portfolio of startups. That's maybe a better way of doing it, because there's lots of different things you could do. Those bets are not all going to pay off, but 2 or 3 out of 5 will be very useful for your core business, and a few of those could really take off. So create a separate unit with power and prestige to explore this future, and give it the mandate to do it in a very different way, away from the core business. Don't let that core business crush it. Don't let the red blood cells crush it. So I would say that's the bet. It's quite a simple thing to do. Sounds simple. It can be quite simple. Doesn't cost very much money, but that thing, the understanding and making a small structural change to create the space where some different type of innovation can happen in a different way. That would be what I would say. Start with that.
Very
Tom, any more questions?
No, very good. But that's the big problem of big corporations. The only exception is the pharmaceutical industry with biotech.
Exactly. It's good. Exactly. Good point.
So, but it was very good last advice for the big corporations.
Simon, is there anything else you'd like to give a shout out to? Any last words for this podcast?
Well, thank you, and thank you, Nicholas and Tom, for having me. I've really enjoyed it. So, by the way, so thank you for that. I think finally, I think this notion of a big societal benefit plus very, very significant commercial opportunity as well. That combination always attracts me. So to have some noble purpose that we can be pushing towards, as well as having the commercial incentives to do it, that seems to fit this space of embedded finance today. So that's why I'm very excited about it. And I think we all should try and learn as much about it as possible and try and make it happen in the most effective way, because it does have that societal benefit, commercial benefit, and then human benefit as well. So that combination is always attractive.
Perfect. Simon, thank you so much. Tom, thank you so much for your time, and everyone have a lovely day. Take care.
Thank you very much.
Thank you.